Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Alasdair Macleod. He's here today to discuss his articles, the July 22nd article, and time permitting, perhaps we can get into the most recent one, the July 29th article. Alasdair is at goldmoney.com. You can read his articles every Thursday. They're published there. And I really think if you're a serious investor, you do want to avail yourself to his insights, because I think they're very valuable. And one of those we want to talk to him about today, and then, that occurred, and he talked about in July, on his July 22nd article, he contrasted the current U.S. stock market bubble to that of the 1929-1932 period. But then he concluded that because the dollar is no longer backed by gold, the most appropriate analog to compare America's current monetary pathology is the French Livre, which was destroyed in an attempt to maintain outrageously overvalued shares of the Mississippi Company. In fact, Alasdair is so sure of the similarity of America's situation to that of France back in around 1720 that he stated in his July 22nd missive, and I quote, "We can now begin to see how markets and monetary events are likely to develop in the coming months," end of quote. Well, listeners might do well to remember the name Richard Cantillon, because he could foresee the unfortunate implosion of the Mississippi bubble, and he profited greatly from that insight. And Alasdair, I think, might have some similar insights into what, at least if he's right about the current situation, as Richard Cantillon had then. And so I'm just hopeful that Alasdair may be able to help this show live up to its name, Turning Hard Times to Good Times. So no pressure, Alasdair, but thank you so much for being back with us today.
That's my pleasure, Jay.
Good. You're here for a reason, and you're here, with absolute guarantee that you're going to make all of my listeners rich. Of course not, but but we do value your insights, because I think they are very valuable, and I believe in them. That's why I like to have you on the show so often. You note in your introduction to your July 22nd article, and I quote once again, you say, "Obviously, the financial asset bubble will burst by rising interest rates, the consequences of rising prices for consumers and essentials." First of all, we're being assured by our smart people, all the smart people in the media, and by the Federal Reserve and all these people, that these price rises are really nothing to be worried about. We've got certain situations that are sort of one-off situations. We got COVID, we've got supply shortages and so forth. But tell us why they're wrong, why it is more serious than what they're letting on.
Well, I think I could sum it up in one very short phrase, and that is vested interest. Anybody who is unfortunate enough to be running monetary policy in these times, I think, has to believe, or at least say, that the problems that we face and they face as policy planners are temporary. That's effectively where they are. But anyone with an ounce of common sense can see that they're not temporary. We have had the most severe knock on the economy. Now, if you're a lawyer in a nice big city like New York or Washington or, I don't know, Los Angeles or something like that, or an accountant, these professionals continue to earn good money because they are, if you like, required come hell or high water. Yeah. But if, on the other hand, you own a corner shop in some town in the Midwest, you have had a hell of a hard time, and you may indeed have been driven out of business. And this is the difference. If you look at the media, the mainstream media basically target their advertising. Their readers are essentially the middle classes. And these are the guys who have survived through this. So you get this impression, looking at mainstream media, that actually everything's all right when COVID's over. We'll be off to the races again, and we can have our holidays and all the rest of it. But actually, the underlying situation is not nearly like that at all. And they ignore the disruption to the supply chains, which, if you talk to any of the logistics experts, they say there's not a cat in hell's chance of this being sorted out this year. Sometime next year, maybe. And this at a time when everybody runs, on just-in-time inventories and stock. So, this is why prices are going up. And I haven't even mentioned what's happened to commodity prices. I mean, you look at commodity prices, they've almost doubled from the moment the Fed turned around and said, right, we're going to print 120 billion a month to support asset prices. We're going to reduce interest rates from 1.5% down to 0. And what happened? The commodity complex took off. Oil actually from April 2020 went from a negative figure, and we're now looking. I haven't seen it today, but we're looking about $70 or something like that.
Right.
These are very serious costs imposed on businesses. Now, businesses either manage to raise their prices or they just shut shop. And that is really the reality of the situation. And it means that quite a lot of production is going to go out. I mean, people have called this stagflation in the past, a combination of inflation and, a sort of recession, as it were, or stagnation. But, I mean, if you look at, the people who haven't gone back to work, very often through their choice, admittedly, having got out of the habit of going to work, perhaps, their spending is concentrating on essentials. So you will see inflation, price inflation, hitting particularly food prices and the essentials in life, like energy, to keep warm and so on, or keep cold in the summer. All this, these are the prices that are going to go up. Now, just because the Fed, if you like, has sort of taken out these volatile components out of its consideration doesn't mean to say that they've banned inflation. What they've done is they've just turned a blind eye to it. And this is a very serious situation where it's not going to go away. It is not a temporary feature. It is not transient. So I think that's the answer to your question. There's a lot of whistling and hoping rather than reality.
Whistling and hoping, and it seems as though most people don't make the connection between the creation of money out of thin air, the massive increase in the monetary aggregates, and prices. Now, they rather like it when the equity markets continue to rise and the bond markets are strong. And as long as they have that kind of inflation, they're happy, but they don't quite see the reason why you have to have bad kind of inflation, is what they look at, bad inflation, consumer inflation, which is really what we're seeing now, isn't it? We're seeing a return to consumer inflation. And I'm guessing that's at least in part because a lot of those smarter investors that see the handwriting on the wall are starting to buy commodities. The Ray Dalios of this world is openly talking. I'm sure other hedge fund guys are talking about that sort of thing. So what's driving it now? Because we've had this massive money creation for decades, and we've not. Admittedly, we've seen more inflation than what the government talks about. You and I have talked about in the past, but we haven't seen, and since the 1970s, any really, really serious inflation in the standard of living for people. I mean, I think it's more serious than they let on, but why now are we really seeing this commodity inflation?
Well, the first thing I would say is that we have been seeing inflation all along. It's just it hasn't been recorded in the official statistics. I mean, I think you've had John Williams on your show.
Oh, yes, absolutely.
In the past. And, he basically uses the same method of calculation back in, was it 1980, when they started introducing methods of, if you like, damping down statistical inflation. So, and on his analysis, he's now saying it's well over 10%. And he's been consistently saying since the last crisis, the Lehman crisis, apart from the year afterwards, that prices have been rising on an unadjusted basis by anything between 5 and 10% ever since then. And we've had this confirmed with the Chapwood Index before that was shut down by COVID. The last Chapwood I saw, we were looking just over 10%, and this was 2019. And that's an arithmetic average of the 50 cities which they recorded prices for 500 commonly bought goods and services. So, the idea that prices are rising at 2%. I mean, it's almost like a goal sort figure, if you like, on a spreadsheet. Yeah. It is not realistic. And if you understand that, then all sorts of other things suddenly start dropping out of the woodwork. Like you ask yourself, okay, if inflation's running, say, at 10% and has been running at, well, let's be kind. Let's say it's been running at an average of 7% for the last 10 years. Then what has been the rate of growth? Hold on a minute. We've been in a recession all that time, because it's been negative, adjusted for this. I'm not saying that this is the way you should calculate it, but this is the way, the method, if you like, in which government statisticians use. What they're in effect doing is they're corrupting the figures to keep the show on the road. And we now have a situation, and this is why the John Law thing, I think, is so important. We now have a situation where that is not enough. What they have had to do is to print money, if you like. In other words, issue cash currency through the banking system to the pension funds and the insurance funds to, in return for which the Fed buys government and agency stock. And the proceeds are spent on more risky assets, which are corporate debentures or corporate loans. You've got that, and equities. And the reason equity markets are where they are is because there is 120 billion a month being pumped into these markets. Now, guess what? That's exactly what John Law was doing 300 years ago. That's why the comparison is so apt. But this time it's on a global basis, not just in France. And the point about France is that the currency collapsed. The company, his import-export business, which we know as the Mississippi Venture, continued to trade. And in fact, the British finally chucked them out of India about 50 years later. So, but the currency, the livre, didn't last through 1720. I mean, on the foreign exchanges in London and Amsterdam, they were completely worthless by that October, I think, by that September.
So what the French bank did was it issued currency to buy the Mississippi company shares, holding them up. Would you say the analogy then, the comparison in the U.S. now and other central banks as well, is the U.S. The Fed has created money. They're buying, QE. They're using QE to buy treasuries, to buy other instruments to keep the rates from rising, right?
Absolutely. I mean, and I can remember seeing Alan Greenspan on television way back at the sort of in the very early noughties, saying that it was very important that stock markets were rising and healthy, because that engendered an awful lot of confidence in the economy. And if you create wealth through rising asset prices, then everything is a lot more stable, and you find that people with portfolios will they end up spending money and keeping the economy in a healthy condition. So it has been Fed policy from Greenspan's time, basically, to ensure that markets are in a healthy condition, if I can can put it that way. So this is nothing new. What we're seeing is the tail end of a policy, which is, if you like, an extension of Keynesianism. And guess what? I mean, if you read John Law's, sort of original thesis, it's Keynesian to the core. It's as simple as that. So we've gone sort of, I suppose, 200 years, because Keynes was about 100 years ago. He was sort of doing his first of his major books. 200 years later, John Law happens again. He just happens to be called John Maynard Keynes, and
yeah.
we're living with the consequences now, and we're seeing the destruction that was wrought on the French economy by the production of unsound money for whatever purpose, and it so happens that we've ended up with exactly the same purpose that John Law originally set out to do. Now he had to do it because the way he promoted his ventures was to do it in issue shares in partly paid form, like 10% down and the other 90% in easy payments. But of course, the problem was that having made various issues, there came a point where calls were due. And of course, people couldn't afford the calls. They'd made an awful lot of money, but they couldn't afford the calls. So they were selling shares in the market. So John Law was in the market printing money to buy them up. Now, that was the condition that he created for himself in those days. The situation now is not quite like that, but the effect is exactly the same. I mean, absolutely. But it is global and therefore considerably more dangerous.
Well, there is a lot of margin debt now, though, Alasdair. I saw we hit new highs for margin debt, so there is some parallels perhaps in that regard too. But in any event, so here we have. You note in your article that the Fed is going to have to create more and more, faster and faster. Essentially, it's going to have to ramp up its QE, and I guess that's because the idea is that there's going to be pressure on the debt markets with inflation rising as it is. And so that's going to mean that they're going to have to ramp up QE more than $120 billion a month or whatever it is now, and put the plunge protection team, the stabilization fund, in motion to buy up the stocks, to buy essentially the Fed or the government buying stocks or bonds or whatever, just going out and supporting the market by direct purchase of those items, right? And if that's the possibility, tell us why that won't work.
Well, it won't work
eventually.
I mean, if I can sort of just take a step back and address your last point.
Sure.
I mean, the Bank of Japan are already doing what you were just saying.
Yeah.
And the way you do it is you go along to, one of the large ETF providers and say, right, we're just going to chuck money into your ETF, go out and buy stocks. So it just gets spread across the whole S&P, for example, sort of an index tracking S&P ETF. So, BlackRock are there ready and waiting, and I'm sure they've already been commissioned to do this. We just haven't actually seen it happen quite yet. But this is definitely on the lines. The problem that they then face is that with prices continuing to rise, unless the Fed actually raises interest rates, then the markets will raise interest rates against them. Now, we haven't seen a situation for a long time where a central bank is out of control of interest rates. But believe you me, it happens, and it can happen, and it will happen again. And the situation will come about simply because there is something like 31 trillion of foreign money invested in U.S. financial assets, including treasuries, equities, and I think there's about 8 billion or something. No, it's less than that. It's 6.5 billion in deposit money. So, it's basically foreigners will look at what's happening in America, what's happening to the dollar, and they will vote with their feet, about holding dollars. So on that basis, I think you'll find that the first pressures will probably show themselves in the foreign exchanges. Obviously, the pressures have already begun to be seen in commodity prices. That is going to continue and could well accelerate as well. And under those circumstances, what does the Fed do? I mean, if the Fed doesn't raise interest rates, it's killing the dollar. If it raises interest rates, it's killing equity markets, and bond markets. So, they're really between a rock and a hard place. And the only way out of it is not for them to announce tapering, which is the anti-inflation, the sensible thing to do, but to step up their purchases in the market, to support the market, just as John Law did back in February, March, and April 1720.
Hmm. Yeah, so that's not no easy option for the Fed at this stage. And I guess if the dollar starts to lose its value, then foreigners that are owning American securities are starting to see losses that occur there in the real value from their perspective of stocks or whatever else they're buying, and that would also then sort of trigger a snowball effect of selling, I would think.
Yes, that's right. And of course, we must not forget that American residents also own foreign stocks. Now, when the US market starts tanking, they're going to start selling foreign stocks. So foreigners, whether they're foreign to America or whether they're Americans operating in foreign markets, are going to turn sellers, and the whole lot will go down, I'm afraid.
Mm-hmm. Well, just with a couple of minutes left here yet, Alasdair, maybe a minute or so, just talk briefly about Richard Cantillon. He saw this coming in France with the Mississippi bubble. Are you suggesting that people that have this foresight now might be able to come out of this situation in much better shape than if they're not aware of it?
Well, I think that's the important thing. I mean, you were saying, you were joking at the start of this that the idea is to make lots and lots of money, but actually, the idea I think is to protect as much as one can what one has. So, on that basis, I think we need to understand the dynamics that are actually driving these markets, and the more you look at them, the more concerned you should be. And I think this Cantillon comparison, I think, is a very, very good starting point to try and understand what might happen.
Yeah, no doubt. And he, I'm sure some people thought he was crazy because he was selling those rising Mississippi shares at a time when people were saying, "What are you crazy? You really having a party here?" And it's just like now, try to step out of the equity markets, and it's hard to do that because they just keep going up. The Fed keeps buying, supporting the markets, and it's really a difficult thing. But I think we do need to try to understand what's going on underneath. And for that, I want to thank you, Alasdair, for being with us once again to help us ferret this out, because it's not what you commonly hear in the mainstream media, and that's why you're so valuable to us. So thank you so much for being with us once again.
That's my pleasure, Jay.